In this video, we're going to talk about something called a T account. A T account is basically a really great way of keeping track of a particular balance in a certain account. Like, for example, you might have a property, plant, and equipment account, right? And you want to keep track of additions and subtractions to your property, plant, and equipment throughout the year. So you set up a T account, and we call it a T account because it looks like a letter T. And basically what you'll have is, because property, plant, and equipment is an asset, you're going to have debits over here on the left side will be entered, and then credits, reductions in PP&E, would be entered on the credit or right side. Okay, so I think this is something that's maybe illustrated a little bit better with an actual example. So let's take some journal entries and convert them into a T account. So let's say that we had an organization, and basically we were selling inventory, and we're trying to keep track of what our inventory level is at a particular point in time. Let's say today we just say, okay, where's our inventory at? So we can look at our past journal entries, right? All these are our journal entries that have taken place, and what we want to do is we want to set up a T account for inventory. So we say inventory, T account, and then we just are going to track what happens with these journal entries and just basically input it directly into our T account, and that'll give us our ending balance. So first we need to know what was the beginning balance in the inventory account before we even did any journal entries. And let's just say that it's a brand new business, and so the beginning balance in this inventory account was 0. Now I'm on the debit side, the left side. It's just by convention because inventory is an asset. And assets, remember, we say they increase with a debit. So whenever we talk about like the beginning balance, typically if it says 0, we'll just put it on the left side. But that's really not consequential. What is important is what happens next. So we say, okay, well, let's take a look at these journal entries and let's start recording them. So what we want to do is look at, for example, our first entry here that takes place on January 9th and say what happened with respect to inventory. We're not really so concerned with cash right now. We'll have a separate T account for cash. We just want to know about inventory and what happened. Well, you can see we have a debit to inventory of $150. So what are we going to do? We're going to enter a debit of $150 into our inventory T account. Now what does this mean? This basically means that we had an addition or increase, or however you want to call it, of $150 of inventory at this point in time. Let me move this down a little bit more. So we also have some action with the inventory going on January 17th. If we look, we see we add some more inventory. How do we know it's increasing? Because it's a debit. We've got the credits are indented, as we talked about, and so the debits are the ones that are not indented. So we've got a debit of inventory of $250. What does that mean? Well, we're going to put on the left side here again. Remember, debit means left, and so we debit inventory for $250. It ends up on the left side in our T account. But now on January 21st, we have some action with inventory where it's actually being credited. It's going down $100. We sold some inventory. We're recognizing the sale. Now remember, we don't care right now about cash or sales or cost of goods sold because we're doing a T account for inventory. And we just want to know what happened to inventory. Well, we see that it's indented, so it's a credit. There's a credit of $100 to inventory. Inventory is an asset. When you credit an asset, you're decreasing it. So we've got $100. I'll just put that in different colors so we've got $100 credit. Now what does this mean? We can think of this, so on the one side we had additions. Here we can think of, you can call it a subtraction, you can call it a deduction, you can think of it however you want. We'll just put subtraction of $100. And then now we have to figure out what is our balance in inventory at the end of this period. So what we want to know is the ending balance, right? We started with 0, and then we added 150, and then we added 250, and we took out 100. Now, you might be able to very quickly do the math in your head, but let me just work through it for you. So when you have the beginning balance of 0, and then you've got the additions, right? And the additions are 150 plus 250. It's these two right here. So that's $400 if we add them together. So we're adding 400 of inventory. And then we're subtracting 100 of inventory. And what does that leave us with? Let me scroll down here a little bit. What does that leave us with? What's our ending balance, our EB, we'll just call it? Well, put the subtraction in parentheses because it's negative. We're actually getting rid of it. So we start with 0. We add 400. 0 plus 400 minus 100. What does that give us? It gives us 300. So our ending balance in inventory is going to be 300. So now, if we say, okay, what's our inventory balance? How much inventory do we have right now? We can say, okay, well, we have inventory of $300, and you can set up T accounts for pretty much any account that you can think of that's ultimately going to go in the financial statements, right? Accounts receivable or cash, or you could have liabilities like accounts payable. You could have equity accounts like retained earnings. All these accounts we're going to talk about, but basically they can all have their own T accounts, and you can go ahead and basically take what happened in the journal entries and go ahead and translate that to the T account, so you can keep a running tally and see what the total is in the account at any particular point in time.